An income tax return is a form which enables taxpayer to declare income, expenses, tax deductions, investments, etc. The Income Tax Act 1961 makes it mandatory under various scenarios for taxpayer to file an income tax return. Section 139 contains various provisions relating to late filing of income tax returns or delayed returns. There are several subsections of Section 139 to deal with non-submission of tax returns within the prescribed time frame by different types of tax assessees. Income tax return (ITR) is a form in which taxpayers file information about his or her income earned and tax applicable to the income tax department. The department has notified various forms, example ITR 1, ITR 2, ITR 3, ITR 4, ITR 4S, etc. The applicability of ITR forms varies depending on the sources of income of the taxpayer, the amount of income earned, and category the taxpayer belongs to, like individuals, HUF, company, etc. The Income Tax Department provides the facility for electronic filing of an income tax return. Every assessee who earns income beyond the basic exemption limit in a financial year must file a statement containing details of his income, deductions, and other related information. Time limit for filing ITR. Any company other than a company who is required to furnish a report in Form 3 CEB is September 30th of the assessment year. Any person who is required to furnish a report in Form 3 CEB under Section 92E is November 30th of the assessment year. Any person other than a company whose accounts are required to be audited under the income tax law or under any other law, September 30th of the assessment year. Working partner of a firm whose accounts are required to be audited under the Act or any other Act, September 30th of the assessment year. Any other assessee by July 30th of the assessment year. Every assessee who earns income beyond the basic exemption limit in a financial year must file a statement containing details of his income, deductions, and other related information. Once taxpayer files the income tax returns, the Income Tax Department will process it. Based on certain parameters by the Central Board of Direct Taxes, the return of an assessee gets picked up for an assessment. The various forms of assessment are self-assessment, summary assessment, regular assessment, and best judgment assessment. Let's see what is self-assessment. The assessee himself determines the income tax payable. The assessee consolidates his income from various sources and adjusts the same against losses or deductions or various exemptions, if any, available to him during the year. The total income of the assessee is then arrived at. The assessee reduces the TDS and advance tax from that amount to determine the tax payable on such income. Tax, if still payable by him, is called self-assessment tax and must be paid by him before he files the return of income. Summary assessment is a type of assessment where the information submitted by the assessee in his return of income is cross-checked against the information that the Income Tax Department has. In the process, the reasonableness and correctness of the return are verified by the department. The return gets processed online and adjustment for arithmetical errors, incorrect claims, and disallowances are automatically done. Regular assessment. Assessing officer or income tax authority not below the rank of an income tax officer shall conduct this assessment. The purpose is to ensure that the assessee has neither understated his income or overstated any expenses or loss or underpaid any tax. The Central Board of Direct Taxes has set certain parameters based on which taxpayer's case gets picked up for scrutiny assessment. In case of best judgment assessment, the assessment gets invoked in certain situations like if the assessee fails to respond to a notice issued by the department instructing him to produce certain information or books of accounts, if he or she fails to comply with special audit ordered by the income tax authorities, the assessee fails to file the return within the due date or such extended timeline as allowed by the Central Board of Direct Taxes, the assessee fails to comply with the terms as contained in the notice issued under summary assessment. After providing an opportunity to hear the assessee's argument, the assessing officer passes an order based on all relevant material and evidence available to him. This is known as best judgment assessment. When the assessing officer has sufficient reasons to believe that any taxable income has escaped assessment, he has the authority to assess or reassess the assessee's income. The time limit for issuing a notice to reopen assessment is 4 years from the end of the relevant assessment year. Time limit for assessment. Income Tax Act 1961 contains different time limits for issuance of notice, filing of application, completion of assessment, passing of penalty order under several sections. Let's look at different sections dealing with time limit for assessment. Section 143 or 144, regular or best judgment assessment is 18 months. Section 147, reassessment is 9 months. Section 153A and C assessments, 21 months. Section 92CA, reference is 33 months. Section 147 assessment is 12 months and Section 254, 263 and 264 fresh assessments are 9 months. In summary, delay in filing the return of income and completing the assessment may attract certain adverse consequences. Some examples are loss other than loss under the head income from house property cannot be carried forward. Levy of interest under Section 234A. Exemptions or deductions under various sections are not available to the assessee.